What if I told you that $1 trillion, that's 1,000 billion, comes from just 1% of American taxpayers every single year? And that if you understand how this system really works, you could potentially keep thousands more of your own hard-earned money in your pocket legally? Most people think they understand taxes, but the reality might shock you. The numbers behind who actually funds America will probably surprise you, the strategies the wealthy use to manage their tax burden might inspire you, and the common mistakes people make trying to save on taxes could save you from financial disaster. Today, we're going to break down America's tax system in a way that actually matters to your wallet. We'll examine who really pays what, explore why the system works the way it does, and most importantly, I'll share practical strategies that can genuinely improve your financial situation, without falling into the traps that cost people more money than they save. The shocking reality of tax distribution. Let's start with a number that will blow your mind. 40% of American households pay absolutely zero in federal income tax. Not reduced taxes, not lower taxes, zero. That's roughly 76 million families who, after deductions, credits, and refunds, contribute nothing to the federal income tax system. But here's where it gets interesting for your personal finances. This doesn't mean they pay no taxes at all. They're still hit with payroll taxes, state taxes, property taxes, and sales taxes. The key insight here is understanding the difference between various types of taxes and how they affect your overall financial strategy. The federal income tax, which we're focusing on today, represents about half of all federal revenue, approximately $2.2 trillion annually. And since 40% of households pay nothing into this system, that entire burden falls on the remaining 60% of Americans. But even within that 60%, the distribution is far from even. The bottom 50% of all income earners contribute just 3% of total federal income tax revenue, while paying an average effective rate of only 3.7% of their income. Here's where the numbers become truly staggering. The top 1% of income earners pay 40% of all federal income tax dollars. That means roughly $880 billion of that $2.2 trillion comes from just 1% of taxpayers. These individuals pay an average effective rate of 26.1% of their income in federal taxes. When we expand to look at the top 5% of earners, we're talking about 61% of all federal income tax revenue. The top 10%? They contribute 72% of all federal income tax dollars collected. Why this distribution exists? This isn't an accident. It's the result of a deliberately progressive tax system. Progressive taxation means two things. Higher earners pay more dollars in taxes, and they pay a higher percentage of their income in taxes. This system emerged from several economic principles. The ability to pay concept suggests that those with greater resources should contribute more to shared societal costs. There's also the marginal utility principle. The idea that each additional dollar means less to someone with millions than to someone struggling to pay rent. But understanding this system is crucial for your personal financial strategy. If you're currently in a lower income bracket, knowing how the brackets work can help you plan for income increases. If you're a higher earner, understanding the progressive nature helps you make informed decisions about timing income, deductions, and major financial moves. The historical development of our tax system. America's tax system wasn't always this way. For most of our nation's history, there was no federal income tax at all. The government funded itself primarily through tariffs and excise taxes. The first federal income tax appeared during the Civil War but was temporary. The modern income tax system began in 1913 with the 16th Amendment, starting with very low rates that applied only to the wealthy. The system we know today really took shape during World War II, when tax rates increased dramatically and the tax base expanded to include middle-class Americans for the first time. What started as a class tax on the wealthy became a mass tax on most working Americans. Since then, we've seen numerous reforms. The 1980s brought significant rate reductions under Reagan. The 1990s saw rates increase on higher earners. The 2000s brought temporary cuts that were later made permanent for most brackets. The 2017 Tax Cuts and Jobs Act reduced rates across all brackets while limiting certain deductions. Understanding this evolution is important because it shows that tax policy is constantly changing. What's optimal today might not be optimal tomorrow, which is why flexible financial planning is so crucial. Common misconceptions about tax fairness. One of the biggest misconceptions in tax discussions is the idea that wealthy Americans don't pay their fair share. The data clearly shows that higher earners pay both higher rates and contribute the vast majority of total revenue. However, this leads to legitimate questions about what constitutes fair. Some argue that since the wealthy benefit more from society's infrastructure, property rights, educated workforce, stable currency, they should contribute proportionally more. Others contend that when a small percentage of taxpayers fund the majority of government operations, it creates economic and political imbalances. There's also the question of different types of taxes. While federal income tax is highly progressive, payroll taxes are regressive because they only apply to wages up to certain caps. State and local taxes vary widely but often include regressive elements like sales taxes. For your personal finances, the key insight is that, fairness arguments aside, you need to plan based on the system that exists, not the system you wish existed. Smart tax planning, beyond the basics. Now let's get to what really matters for your wealth building: how to legally optimize your tax situation. But first, let me share the most important principle in tax planning. Never let tax considerations override good financial decisions. I've seen too many people make poor financial choices solely to reduce their tax bill. They focus so much on saving taxes that they forget the goal is building wealth. A 10% reduction in taxes rarely beats a 20% increase in income. That said, there are legitimate strategies that can significantly impact your financial situation. Business ownership advantages. One of the most powerful tools for tax optimization is owning a business. Business owners can deduct legitimate business expenses that employees cannot. This includes home office expenses if you work from home, business vehicle costs, equipment purchases, travel expenses, and educational costs related to your business. The key word here is legitimate. The IRS requires that expenses be ordinary and necessary for your business. But if you're already incurring these expenses, taking the deduction is simply smart planning. For many people, even a side business can provide significant tax benefits. Freelance work, consulting, e-commerce, or service businesses can all generate deductible expenses while building additional income streams. Retirement account optimization. Retirement accounts are perhaps the most underutilized tax planning tools available to average Americans. Traditional 401k and IRA contributions reduce your current taxable income while building long-term wealth. If your employer offers a match, not taking it is literally leaving free money on the table. For higher earners, maxing out retirement contributions can provide significant tax savings. In 2024, you can contribute $23,000 to a 401k, plus an additional $7,500 if you're over 50. That's potential tax savings of over $7,000 for someone in the 24% bracket. Health savings accounts offer even better benefits. They're deductible going in, grow tax-free, and are tax-free coming out for medical expenses. After age 65, you can use them for any purpose with only ordinary income tax, making them similar to traditional IRAs with better current benefits. Investment strategy considerations. How you hold investments can dramatically impact your after-tax returns. Long-term capital gains receive preferential tax treatment, with rates of 0%, 15%, or 20% depending on your income, compared to ordinary income tax rates that can reach 37%. This means holding investments for over a year before selling can save substantial taxes. Tax loss harvesting, selling losing investments to offset gains, can further optimize your tax situation. For higher earners, municipal bonds from your state might provide tax-free income, though you need to compare the after-tax yield to taxable alternatives. Dangerous tax strategies to avoid. Now let me warn you about some popular tax strategies that often backfire. The real estate professional trap. Social media is full of experts promoting real estate professional status as a tax-saving strategy. The idea is that real estate professionals can use property losses to offset other income, potentially creating large deductions. The reality is much harsher. To qualify, you must spend at least 750 hours per year in real estate activities, and this must represent more than 50% of your working time. If you work full-time elsewhere, you'd need over 2,000 hours in real estate, essentially 2 full-time jobs. Worse, many activities people think count, like research, reading, or attending conferences, often don't qualify under IRS scrutiny. When audited, taxpayers frequently lose these deductions and owe back taxes plus penalties. The short-term rental loophole. Another popular strategy involves short-term rentals like Airbnb properties. These have special rules allowing losses to offset other income if you meet certain requirements. You must spend at least 100 hours on the property and do more work than anyone else involved. This means if you hire a property manager, cleaner, or maintenance person who works more hours than you lose the benefit. I've calculated that the time required to maintain these benefits is often worth more when applied to primary income sources than the tax savings generated. The equipment purchase rush. Business equipment purchases can often be deducted 100% in the first year under current bonus depreciation rules. This leads many people to buy expensive equipment they don't really need just for the tax deduction. Remember, spending $50,000 to save $15,000 in taxes still costs you $35,000. Only buy equipment that genuinely helps your business generate more income. The wealthy's real tax strategy. Here's what truly wealthy individuals understand about taxes. The goal isn't to pay zero taxes, it's to maximize after-tax wealth. They focus on building income first, then optimizing taxes second. Wealthy individuals typically employ several strategies. They structure their affairs to take advantage of preferential rates on investment income. They time the realization of gains and losses strategically. They use retirement accounts and other tax-advantaged vehicles to their maximum extent. They make charitable contributions that align with their values while providing tax benefits. But most importantly, they don't let tax considerations prevent them from making money. They understand that paying taxes on $1 million of income leaves them much wealthier than paying no taxes on $50,000 of income. Practical steps for different income levels. Your optimal tax strategy depends largely on your current income and situation. For lower to middle income earners, focus on maximizing employer 401k matches, using tax-advantaged accounts like HSAs, and taking advantage of credits like the Earned Income Tax Credit or Child Tax Credit. Consider developing side income streams that might qualify for business deductions. For higher income earners, maximize all available retirement account contributions. Consider whether your tax situation benefits from traditional versus Roth account contributions. Explore legitimate business opportunities that provide both income and deductions. Work with qualified professionals to ensure you're optimizing your situation properly. For business owners, keep meticulous records of legitimate business expenses. Consider whether your business structure is optimal as you grow. Plan major purchases and income recognition around tax years. Stay current on changing tax laws that affect your business. The bottom line on tax planning. The data shows clearly that America operates a progressive tax system where higher earners pay both higher rates and contribute the vast majority of federal income tax revenue. This system has evolved over more than a century and continues to change with new legislation. For your personal finances, the key principles are simple. Focus on increasing your income first and optimizing taxes second. Take advantage of legitimate deductions and credits available to your situation. Avoid strategies that prioritize tax savings over wealth building. Work with qualified professionals when your situation becomes complex. Remember, taxes are just one component of your overall financial picture. Understanding how the system works empowers you to make better decisions, but the goal is always building long-term wealth, not just minimizing this year's tax bill. Looking forward, tax laws will continue to evolve, and your personal situation will change over time. The strategies that work for you today might not be optimal in 5 years. Stay educated, remain flexible, and always remember that the best tax strategy is the one that leaves you wealthier in the long run. The American tax system might seem complex, but understanding its basic structure and principles puts you ahead of most people. Use this knowledge wisely, focus on building wealth, and let smart tax planning support, not drive, your financial decisions. Whether you're just starting your financial journey or looking to optimize an already successful situation, remember that knowledge is power. The more you understand about how taxes really work, the better equipped you'll be to build the financial future you want. Thanks for watching, and remember, the goal isn't just to save on taxes, it's to build real, lasting wealth.